It's crazy how time flies. We're in the middle of tax season already. Average employees pay around 28% of their income in taxes in the US. That's a lot. And many people don't know how taxes are calculated or how much they own. So today, I'll explain the tax implications of different types of income, the good, the bad, and the ugly. By the end of the video, you'll get a much better understanding of your income tax implications, so get ready to learn. Hi, I'm Prudence Zhu, CPA and a fee-only financial planner. I love helping people like you understand your taxes and how to reduce them. I also provide tax and wealth strategies to professionals and small business owners so that they can effectively create, communicate, and protect their wealth and live the life they want. Let's get started. The first type of income is earned income. Unfortunately, it is also the income with the highest tax rate. It is generally defined as income from employment or operating your own business or farm. The taxes you pay as an employee for earned income are payroll taxes, namely Social Security and Medicare, and income taxes at federal, state, and local levels. And I'll only focus on the federal taxes today. For most employees, the payroll tax rate is 7.65%, of which 6.2% is for Social Security and 1.45% is for Medicare. They are automatically deducted from every paycheck. On the other hand, if you have side income, work as a contractor or sole proprietor, or own a single-member LLC, your payroll tax rate would double to 15.3% because you'd be paying both the employer and employee portion, and you are responsible for making timely tax payments. So if you are self-employed or run your own business, remember to include the payroll taxes in your cost and pricing, as well as make appropriate estimated tax payments each quarter. As for federal income tax, the tax liability of your earned income for both employees and self-employed workers depends on how much you make. For the tax year of 2023, the federal income tax rates range from 10% to 37%. And I have a separate video on all the details of the progressive tax system in the US, the various tax brackets, how you could get some savings, and a case study. So check it out if you are interested. As I mentioned, earned income includes many different income sources: salaries, wages, tips, bonuses, and other forms of compensation you receive in exchange for your labor or services. Earned income can also include net earnings from self-employment or working for yourself, such as freelancing and part-time work, contractor work, or running your own business. And I differentiated self-employment income in italics, meaning those are subject to up to 15.3% in payroll taxes plus ordinary income tax based on your tax bracket. I also have to point out that if you own and manage a short rental property yourself, it would most likely be considered a trade or business for tax purposes. You would report the rental income and expenses on Schedule C, Profit or Loss from Business, of your individual income tax return, Form 1040. So the income from short rentals is considered self-employment income, subject to the highest tax rates. Usually, rental income is ordinary income, which I will talk about next, but short rental is an exception. So if your earning on Airbnb or Vrbo is significant, you'd receive 1099 forms from them. And you'll have to remember to keep accurate records of revenue and costs, as well as make proper estimated tax payments in time to avoid penalties and interests. On the other hand, real estate activities also have many tax benefits, which I'll discuss in a future video if you are interested. The second type of taxable income is ordinary income. It is mostly passive income excluding long-term capital gains, and it's subject to ordinary income taxes. Passive income in the US is taxed differently from earned or self-employment income. It is not subject to payroll taxes. Instead, it is generally subject to ordinary income taxes, ranging from 10 to 37%, depending on your tax bracket. This includes short-term capital gains, interest income, non-qualified dividends, and income from rental properties, not including short-term rentals. If you own equity in S-corporations and limited partnerships or other investments, your share of net income from the business is also subject to ordinary income tax. The tax form you'd receive is K1, and you'd include the information in your personal tax return. Tax on passive income can be offset by passive losses. For example, if you have long-term rental income from an investment property, but your rental expenses exceed the rental income, which is pretty common once you include the depreciation. In that case, you can use the passive losses to offset other passive income earned during the same tax year. In tax planning, we say every pig needs a pal. Not that kind of pig though. I mean passive income generator. You can offset the tax liability of a passive income generator with a passive activity loss, or PAL. Real estate is frequently used as a PAL in tax planning. And if you're interested, please let me know in the comments below, and I'll talk about it in a future episode. It's essential to keep accurate records of all passive income earned and any associated expenses or losses to ensure that the correct amount of tax is paid. Additionally, it is advisable to consult with a tax professional to ensure that all applicable tax laws are followed and to take advantage of all the available deductions and credits. Now we move on to the third type, long-term capital gains. In the United States, they are taxed at lower rates than ordinary income because the government wants to encourage long-term investments. They are gains from the sale of assets held for more than a year, and its federal tax rate range from 0% to 20%, depending on your adjusted gross income or AGI. That is all of your income minus the qualified deductions, which includes pre-tax contributions to tax-advantaged accounts such as FSA, HSA, 401k, and traditional IRA. For example, if you are single and AGI was between $41,676 and $459,750 in 2022, your long-term capital gain would be 15%. And the range for a married couple filing jointly was $83,351 and $517,200. If you make below that range, your long-term capital gain tax would be 0%. And if you are making above that range, it would be 20%. In addition to these tax rates, there may be an additional 3.8% net investment income tax for individuals with high incomes, which applies to certain investment income, including long-term capital gains. In order to qualify for the long-term capital gain tax, the appreciated asset must be held for more than a year. The holding period for an asset starts on the day after its acquisition and ends on the day it is sold. Qualified dividends are also subject to capital gains tax. A U.S. corporation or an eligible foreign corporation can pay qualified dividends. The stock should be typically held for more than 60 days, and it can't be expressly excluded stocks. For example, the preferred stocks that is not publicly traded. One thing shareholders of S-corporations have to pay attention to is not taking excess distribution from the business. If they get a distribution that is in excess of their basis of the stocks they own, it will be subject to capital gains tax. It is like a punishment for taking too much cash out of the business. So for example, if you invested $20,000 in the business and the net income for the year is $30,000, any distribution over $50,000 would be considered excess distribution. But on the other hand, if you take less than your investments and net income, your basis would grow over time. And here's a summary of the three types of taxable incomes. Self-employment and other earned income have the highest taxes. Ordinary income tax rates is in the middle, and long-term capital gains are the most tax-friendly. In addition, there are many tax-free or tax-exempt incomes, and I talked about the most frequently used ones in this video. To solidify what we've learned, I'll go over a case to compare the tax liabilities of the same amount of income from different sources. I simplified the scenario so that it would be easier to understand and compare. Mr. Dream is a consultant making $135,000 in salaries and bonuses combined in 2023 with no other income. So he'll pay 6.2% of Social Security tax, which is $8,370, and another 1.45% or $1,958 for Medicare. He's single and doesn't contribute to any tax-advantaged accounts, which is not recommended, but let's go with it for simplicity. So he has no adjustments, and his AGI is still $135,000. He takes the standard deduction of $13,850 for the year, which makes his taxable income $121,150. The calculation for taxable income is AGI minus the standard deduction or itemized deduction. But here we just use the standard deduction for simplicity. With no other credits or penalties, his federal income tax for the year would be $22,476. His total tax liabilities for Social Security, Medicare, and federal income tax would be $32,804, or 24% of his gross income. His after-tax income would be $102,197. I must point out that the Social Security tax maxes out at $160,200 of income in 2023. So if your earned income is higher than that, you only have to pay Social Security taxes on the first $160,200 of your earned income. There is also a 0.9% additional Medicare tax for high-income people, but neither of the two is relevant for today's case with Mr. Dream. Let's move on to the second scenario. Mr. Dream wanted more flexibility and became a contractor at the beginning of the year. He's paid the same $135,000 for his work. In that case, he is a sole proprietor, and he'll have to pay double in Social Security and Medicare taxes compared to when he was an employee. He's now considered self-employed in the eyes of the IRS and has to pay both the employer portion and the employee portion. However, half of that, which is $10,328, is deductible as business expense to reduce his AGI. As before, he has no other adjustments and takes the standard deduction as a single taxpayer. His taxable income would be $110,823, and federal income tax would be $16,674. His total tax liabilities, including self-employment tax and income taxes, would be $37,329. His total tax liability represents 28% of his gross income, and his take-home pay would be $97,671. So you can already see there's an increase in his tax liabilities and drop in his take-home pay. In reality, though, people usually charge a much higher hourly rate for contractor work. But that would complicate the comparison here, so let's keep it an apples-to-apples comparison. Like you, Mr. Dream also didn't like paying high taxes, so in the third scenario, he sets up an S-Corp to reduce his taxes. He has 100% ownership in the business and pays himself $60,000 a year as salary. And the net income from the business at the end of the year would be subject to ordinary income, but not payroll taxes. So for the salary portion, he'll have to pay 6.2% Social Security tax and 1.45% Medicare tax, which is $4,590. And the S-Corp would pay the same amount for the employer portion. Keeping the same total income of $135,000 as the previous two scenarios, his net business income would be net of his salary and employer portion of his payroll taxes, which is $70,410. Keeping the same total income of $135,000 as the previous two scenarios, his net business income would be net of his salary and employer portion of his payroll taxes, which is $70,410. And his AGI would be $60,000 salary plus the net business income, totaling $130,410. With no other adjustments and using the standard deduction again, he will pay federal income tax of $21,374. His tax liabilities total $30,554, or 23% of his gross income. Taking home pay would be $104,446. Granted, this is a very simplified model, and I excluded other tax benefits of S-Corp such as healthcare insurance deductions, administrative and other business costs, as well as QBI deductions. So in reality, there's a lot more opportunities you could take advantage of on tax planning for S corporations. If you have questions, please email me with your specific situation. And the last scenario is Mr. Dream runs his consulting business as a C-Corp because he sees the great potential for his business and wants to get funding from various investors to grow the company. So assume he owns 100% of the C-Corp as of now. As in the previous scenario, the gross income for the year remains $135,000. Same as before, he pays himself $60,000 in salary, and only the dividend payout would be included in his tax return on Form 1099 Div for dividend. Again, let's assume no adjustments or other deductions. His AGI would be $60,000 plus any dividend payout. The net income from the business, netting the employer portion of payroll taxes, would be $70,410, same as scenario 3. Since the Tax Cut and Jobs Act in 2017, most C corporations now pay a flat tax rate of 21%. To simplify the analysis, let's ignore any state or local taxes. So after paying 21% federal business income tax, the net profit would be $55,626 and it would be available for dividend payout. If Mr. Dream pays himself dividends this year, and assuming it's qualified dividend, it would be subject to long-term capital gains tax, which would be 15% at his income level. So if he pays out all the net profit as dividends to himself, he'd be liable for $8,344 in long-term capital gains tax. As you can see, the business income of a C-Corp is taxed twice, first at 21% and then at 15% when the dividend is paid to the shareholders. People call it the double taxation of C-Corp. So at the end of the year, Mr. Dream would take home anywhere between $49,949 if he pays himself no dividend and $97,229 if he distributes all the net profit that year. Here's a summary of the 4 different scenarios for Mr. Dream. You'll notice that his total tax liability as a percent of gross income is relatively low as an employee and owner of S-Corp, paying himself a small salary. After-tax income is also higher in those 2 scenarios. On the other hand, the sole proprietor and C-Corp has the highest total tax liabilities and lowest take-home pay. However, these 4 scenarios are simplified. There are plenty of benefits out there for small business owners to set up as S-Corp and C-Corp. But every business is different, so selecting the right entity is a very important decision. And it's a good advice to consult tax and legal professionals. I hope today's video helped you understand your tax liabilities and put you in a better position to prepare and plan for your taxes. If you are also interested in reducing your tax liabilities, please stay tuned for my next video where I'll talk about 4 strategies tax planning professionals use to minimize taxes. If you liked today's video, please give it a thumbs up and share it with others. Please subscribe to my channel to learn more tax and wealth strategies to build the life you want. See you next time!